Have you ever bought a stock just because everyone was talking about it, only to watch it crash and burn moments later? Or maybe you held on to a losing investment for way too long, hoping it would bounce back, but it just kept sinking. If that sounds familiar, you're not alone. It's a classic story, and it's exactly what we're going to tackle today. Welcome to Wealthnetic Channel, where we decode the complex world of finance to help you build lasting wealth. I'm your host, and today we're diving deep into one of the most influential investing books ever written, A Random Walk Down Wall Street by Burton Malkiel. We're going to expose the hidden psychological traps that cost investors fortunes. By the end of this video, you'll understand why our brains are often our own worst enemies when it comes to money. We'll uncover three major biases: the herd instinct that makes us follow the crowd, the overconfidence that convinces us we're smarter than the market, and the loss aversion that makes us terrified of taking a loss. Most importantly, I'll give you a simple, actionable system to sidestep these traps and invest with clarity and confidence. Ready to stop gambling and start investing? Let's get into it. Let's start with the first major bias: the herd instinct. You know how it is. A new tech stock is the talk of the town. Your friends are bragging about their gains, and every news headline is screaming buy, buy, buy. The fear of missing out, or FOMO, kicks in. You jump on the bandwagon without doing your own research, convinced you're on a rocket to the moon. This is the herd instinct in action. It's a deep-seated survival mechanism from our ancient past when sticking with the tribe meant safety. But in the stock market, the herd often runs right off a cliff. Think about it like this. Imagine you're at a crowded concert, and someone suddenly starts running. A few others follow, then a dozen, and soon there's a stampede. You don't know why they're running, but you run too, just to be safe. That's exactly what happens during market bubbles. The dot-com bubble in the late 90s is a perfect example. People poured money into internet companies with no profits or even revenue, simply because everyone else was doing it. When the bubble burst, fortunes were wiped out. Malkiel argues that following the herd is one of the quickest ways to lose your money. So, how widespread is this herd behavior? It's a global phenomenon. A study from the International Journal of Economics and Finance analyzed investor behavior across different markets and found that herd mentality is prevalent everywhere, from developed markets in the US and Europe to emerging markets in Asia. It doesn't matter what your culture is. The psychological pull to follow the crowd is universal. This shows us that it's not about being smart or dumb. It's about being human. The pressure to conform is incredibly powerful, but being aware of this universal tendency is the first step toward resisting it. So, how do we actually do that? How do we build a dam against this powerful current of social pressure? This leads us to the first part of our Wealthnetic system. Step 1. Create an investment policy statement. This is your personal rule book for investing. Before you even think about buying a stock, write down your goals, your risk tolerance, and the types of assets you will and won't invest in. This document becomes your anchor. When the winds of market hype start blowing, you refer back to your plan, not to the headlines. It forces you to be disciplined. Step 2. Automate your investments. Set up automatic contributions to a low-cost, diversified index fund, or ETF. This is the ultimate anti-FOMO strategy. You're consistently investing on a schedule, regardless of what the market is doing. This method, known as dollar cost averaging, takes emotion completely out of the equation. You're no longer trying to time the market. You're just building wealth steadily over time. It's simple, effective, and it works. Now, let's move on to the second bias: overconfidence. How many of us secretly believe we can outsmart the market? We think we can pick the winning stocks, time the market peaks and troughs, and beat the pros at their own game. This is our ego talking. Malkiel presents a mountain of evidence showing that even professional fund managers, with all their resources and expertise, consistently fail to beat the market average over the long term. If the pros can't do it, what makes us think we can? Overconfidence is like thinking you can navigate a minefield blindfolded just because you have a good sense of direction. You might get lucky once or twice, but eventually, your luck will run out. This bias leads us to trade too frequently, racking up transaction costs and taxes, and to take on far too much risk. believing we've found the next big thing. And this isn't just a hunch. The data backs it up. A famous study by Professors Barber and Audion, titled Boys Will Be Boys, found that male investors, who tended to be more overconfident, traded 45% more than female investors. And what was the result? Their overactive trading caused their net returns to be significantly lower. They were churning their own portfolios into the ground. This overconfidence isn't limited to one gender or country. It's a deeply human trait. We're wired to believe in our own abilities. But when it comes to the complex, unpredictable system of the stock market, our confidence is often misplaced. So, what's the mechanical fix for our own ego? Here's the next step in our system. Embrace index funds. This is the core of Malkiel's philosophy. Instead of trying to pick individual winners, you buy the whole market through a low-cost index fund, like one that tracks the S&P 500. By doing this, you're guaranteed to capture the market's average return, which, as we've seen, is better than what most active stock pickers achieve. It's a humble approach. It's an admission that you don't know more than the collective wisdom of millions of investors. And that's not a weakness. It's a strength. It frees you from the stress of constant monitoring and the illusion that you need to be a genius to succeed in investing. You just need to be disciplined. Finally, let's talk about the third, and perhaps most powerful bias. Loss aversion. Psychologically, the pain of losing $1 feels about twice as strong as the pleasure of gaining $1. This makes us do irrational things. It's why we hold on to losing stocks, telling ourselves, I'll sell as soon as it gets back to what I paid for it. We're so afraid of locking in a loss that we write a failing investment all the way down, turning a small mistake into a catastrophic one. It's like refusing to get a small cavity filled, hoping it will heal on its own, only to end up needing a root canal later. On the flip side, loss aversion also causes us to sell our winning stocks way too early. The moment we see a profit, we get nervous about losing it. So we cash out, missing out on much bigger potential gains. We cut our flowers and water our weeds. This phenomenon has been studied extensively. Daniel Kahneman and Amos Tversky's prospect theory, which won a Nobel Prize, mathematically demonstrated this very asymmetry in how we perceive gains and losses. It's a cognitive glitch hardwired into our brains. We are fundamentally risk-averse when it comes to our gains, but become risk-seeking when faced with a loss, desperate to get back to even. This explains why people will double down on a bad bet, whether it's at the casino or in their brokerage account. It's not a logical decision. It's an emotional reaction to pain, but acknowledging this glitch is the first step to overriding it. How can we systematically short-circuit this powerful emotional response? This brings us to the final step of the wealthnetic system. Set stop-loss and take profit orders. This is a purely mechanical way to enforce discipline. A stop-loss order is an instruction you give your broker to automatically sell a stock if it falls to a certain price. Say, 10% below what you paid. This caps your potential losses and prevents you from emotionally clinging to a sinking ship. Conversely, a take-profit order lets you sell a stock once it hits a certain profit target. A more advanced strategy is to use a trailing stop-loss on your winners. This allows your profits to run but locks them in if the stock starts to reverse course. By setting these rules in advance, when you're calm and rational, you take your future, emotional self out of the decision-making process. You're running a system, not riding an emotional roller coaster. So, let's pull it all together. We've talked about the 3 big psychological biases that Burton Malkiel warns us about. First, the herd instinct, which makes us follow the crowd, often off a cliff. Second, overconfidence, our arrogant belief that we can outsmart the entire market. And third, loss aversion, the paralyzing fear of taking a loss that causes us to make terrible decisions. The solution to all of these is the wealthnetic system, a simple, mechanical approach. First, you create your personal investment policy statement to act as your constitution. Second, you embrace diversification and automation by investing in low-cost index funds. And third, you pre-commit to your exit strategy by using stop-loss and take-profit orders. Look, fighting against your own psychology is hard. These biases are a fundamental part of who we are. There's no shame in feeling the pull of FOMO or the sting of a loss. But successful investing isn't about having no emotions. It's about having a system that prevents your emotions from wrecking your financial future. It's about replacing impulsive reactions with disciplined actions. You have the power to build that system, to be the master of your financial destiny, not a slave to market whims. Thank you so much for investing your time with us today. If you found this breakdown helpful and want to learn more about building wealth the smart way, please hit that subscribe button and ring the bell so you never miss an episode. And hey, drop a comment below and let me know which of these biases you've struggled with the most. We're all in this together. Thanks for watching, and I'll see you in the next video.